Hey everyone, and welcome to The Explainer. Today we're tackling one of the absolutely most fascinating and high-stakes subjects in all of macroeconomics. We're talking about the complex, completely interconnected web of open economies. I mean, goods, services, and money are flowing across borders every single second of the day, right? Well, today we're going to untangle exactly how all of that works.
Okay, let's dive into this. And let's start with a question you've probably never really thought about while binging your favorite show. How does a television manufactured overseas actually end up sitting right there in your living room? It seems like such a simple, everyday transaction, doesn't it? You go to the store, you swipe your card, you take the TV home. Boom, done. But behind that swipe is a massive, invisible macroeconomic engine literally working overtime. To get that TV across the ocean, currencies had to be traded, international price levels had to be negotiated, and national trade balances were heavily impacted. It's honestly the perfect starting point to understand the whole global economy. So, here is our roadmap for today. First, we'll cover the foreign exchange market, then the trade balance. After that, we'll hit the open economy equation, and finally, we'll wrap up with the ultimate policy dilemma.
All right, let's kick things off with Section 1, the foreign exchange market. You see, before a single physical box is even loaded onto a cargo ship, international trade requires a swap of national currencies. Let's look at how this actually plays out in practice. When a firm wants to buy goods from overseas, they almost always have to pay in the seller's currency. For instance, if an Australian importer wants to buy a massive shipment of those televisions from a manufacturer in Japan, they can't just hand over a pile of Australian dollars. It doesn't work like that. They have to find the equivalent amount of Japanese yen to complete the purchase. And conversely, if a foreign company wants to buy world-famous Australian beef, they've got to acquire Australian dollars to pay for it. This demand for foreign currency is what we call a derived demand, meaning it's driven entirely by our underlying desire for foreign goods, services, and assets. So how exactly do we know how much of one currency equals another? Well, that brings us to the nominal exchange rate. Think of this simply as the price of a unit of domestic currency, but expressed in terms of a foreign currency. Let's say the exchange rate is sitting at 125 yen per Australian dollar. That means the Australian importer knows, for sure, they must pay exactly 1 Australian dollar for every 125 yen they need to secure those TVs. And this rate isn't magic. It is completely determined by a constant, real-time tug-of-war of supply and demand for those currencies on the global foreign exchange market. Now, what's really wild is how these currency movements create distinct winners and losers within the exact same country. It's like a giant economic seesaw. When your domestic currency appreciates, meaning it goes up in value, it's party time for domestic shoppers. Imports become so much cheaper because your money just goes further abroad. But for domestic exporters, total nightmare. Their goods just became far more expensive for foreigners to buy. Now flip that around. Currency depreciation makes your exports highly competitive on the global market because they're suddenly dirt cheap for foreign buyers. But at the exact same time, it seriously hikes up the cost of importing goods for your own citizens. Moving right along to Section 2, the trade balance. Now that we've got a handle on how currencies actually facilitate trade, let's look at the massive physical flow of the goods themselves. In macroeconomics, we measure this flow using something called net exports, which is often abbreviated as NX. The formula here is wonderfully simple. It's just the difference between a country's total volume of exports, which we call X, and its imports, which we call Z. So X minus Z. But what's actually driving these two variables? Well, the volume of your exports relies heavily on foreign income and relative prices. Simply put, if other countries get richer, they buy more of your stuff. Imports, however, depend on your own domestic income and those same relative prices. So if your citizens get wealthier, they start buying more goods from overseas. So the absolutely crucial point here is that this dynamic creates one of two primary outcomes for any nation. If we sell more to the rest of the world than we buy from them, boom, we have a trade surplus. Our exports are greater than our imports. But if we buy more from the rest of the world than we manage to sell back to them, we fall into a trade deficit. And as we'll see in just a minute, running a massive sustained deficit is something governments generally want to avoid over the long term, mostly so they don't rack up an excessive amount of foreign debt. All right, let's zoom out a bit for Section 3, the open economy equation. We have our currencies, we have our trade balance. Now it's time to assemble these building blocks. Before we can look at the whole world, we really have to look at what a country spends strictly on itself. We call this domestic absorption. It is the total domestic expenditure on goods, and it's calculated by simply adding together consumer consumption, business investment, and government spending. You'll hear this referred to all the time as C plus I plus G. It's an incredibly important baseline. It basically represents the domestic economy absorbing goods and services before we even factor in international trade. But remember, we are in an open economy now, so we have to redefine aggregate demand, which is the total demand for our country's products. We take that domestic absorption, our C plus I plus G, and we simply add our net exports to it, and that gives us our open economy identity. Aggregate demand equals consumption plus investment plus government spending plus net exports. And this brilliantly illustrates how we actually find equilibrium in an open goods market. For an economy to be in balance, total domestic output, represented here by Y, must equal aggregate demand. So we get this super comprehensive equation. Output equals domestic expenditure, which is driven by income and interest rates, plus net exports, which is driven by domestic income, foreign income, and the exchange rate. It's a delicate ecosystem. Every single time a currency fluctuates, or a foreign nation gets richer, or domestic interest rates change, this equation shifts and the whole economy has to desperately rebalance itself. Which brings us to the final piece of the puzzle, Section 4, the ultimate policy dilemma.
This is really the climax of our explainer, because economies don't just magically balance themselves perfectly on their own. Governments are effectively acting like tightrope walkers. They are desperately trying to maintain two very different types of balance at the exact same time. The first is internal balance. This means keeping the economy at full employment. If you drop below it, people lose their jobs. If you go too high above it, you trigger rampant inflation. But they also have to maintain external balance. That means aiming for a scenario where the trade balance is zero, where net exports equal exactly zero. Like I mentioned earlier, sure, countries can tolerate temporary deficits, but if you ignore external balance forever, you end up buried in foreign debt or completely draining all your national reserves.
And this builds into an absolute nightmare for policymakers. Now, sometimes the government gets lucky. Take a scenario where a country has high unemployment but is simultaneously running a trade surplus. Let's call that scenario 1. There is no conflict there. The government can use expansionary policies like cutting interest rates or spending more money, which boosts income, gets people back to work, and conveniently encourages just enough imports to balance out that trade surplus. It's a total win-win. But imagine scenario 2, where there is a direct conflict. Imagine a country is at full employment. Everyone has a job, but they are running a massive trade deficit. The government is completely trapped. If they use contractionary policy to slow down the economy and fix the deficit, businesses will suffer and people will lose their jobs, completely ruining the internal balance. But if they prioritize full employment and do nothing, they'll just continue bleeding money to foreign nations, ruining the external balance.
So, how on earth do governments escape this trap? Well, the source material points to something called expenditure switching policies. Rather than changing the total amount of money people are spending, which is what causes those job losses, governments try to shift what people are spending their money on. They try to switch demand away from foreign goods and back to domestic goods. How? They might intentionally devalue their own currency, instantly making foreign imports painfully expensive for their citizens, while making their own exports cheap for the rest of the world. Or they might slap tariffs and quotas on imported goods to artificially block them from entering the country. Alternatively, they could offer export subsidies, which is essentially paying domestic firms to sell their products abroad. By combining these switching tactics with standard monetary policy, policymakers just cross their fingers and pray they can hit that magical sweet spot of both full employment and a balanced trade book.
Wow, we've covered a tremendous amount of ground today, from the simple act of trading currencies for a flat-screen TV, to the complex equations that dictate aggregate demand, right up to that crazy tightrope walk of government policy. So I want to leave you with a question to ponder. Look at the news today. Look at the policies being debated right now in your own country. Is your economy currently sacrificing full employment in a desperate bid to balance its trade? Or are you running up massive deficits just to ensure everyone keeps their jobs? Let me tell you, once you understand these underlying macroeconomic forces, the daily global news starts looking a whole lot different. Thank you so much for joining me for this explainer. Keep asking those big questions, and I will see you next time.